morning, everyone. Let's explore the foundation of accounting. We want to understand the elementary aspect of accounting. So, even if you're not an accountant, you'll find it easy to understand if you listen carefully to me. I will explain the basis in simple terms. Let's go. First, you need to know that accounting is a language of business. We need figures to tell stories about a business performance. With figures, we can determine if a business is successful or not and predict its future prospects. For example, let's say you are the owner of a small business and you want to know if your business is making a profit or not. You can use financial statements like the income statement and the balance sheet to get a snapshot of your business performance. So if you want to love accounting, you must love figures. Understanding figures is important for anyone building a career in accounting. So now let's look at the key principles of accounting. The foundation of accounting is built on several key principles and concepts. You can't be fully grounded in accounting without understanding these principles. Let's look at these principles and explain it in the simplest language. Number one is accounting equation. In accounting equation is equal to assets equal liability plus equity. This principle states that a business assets are always equal to its liabilities plus equity. Let me explain. For example, if you start a business with 100,000 naira in cash and you borrow 50,000 naira from a friend, your asset will be 150,000 naira. That is 100,000 naira in cash and 50,000 naira borrowed. And your liability would be 50,000 naira. That is the amount borrowed. While your equity would be 100,000 naira, the amount you invested. Number two, double entry bookkeeping. This principle states that every financial transaction affects at least two accounts. For instance, if someone buys goods worth 20,000 naira from your shop and pays cash, this transaction affects two accounts. Your cash would increase by 20,000 naira in that business, and your goods will reduce by 20,000 naira. This is a simple principle of double entry. Number three is accrual accounting. This principle of accrual accounting states that revenue and expenses are recognized when earned or incurred, regardless of cash flow. Let me explain. For instance, let's say that you own a provision store and someone comes to buy goods worth 50,000 naira on credit, believing they will pay in 3 months' time. You wouldn't receive cash immediately, but you will still record the sales as revenue because you have transferred the ownership of that goods to the buyer. So in accounting, revenue is not only recognized when cash is received, it is recognized when the goods have been transferred to the buyer. Number four, we have what is called the matching principle. The matching principle of accounting states that expenses should be matched with revenue in the same period. For example, if you sell goods worth 50,000 naira in a month and you incur 20,000 naira in expenses to generate those sales, you should record both the revenue and expense in the same period. That is what is called the matching principle. We now also have what is called the materiality concept. The materiality concept states that all material transactions and events should be reported in the financial statement. For instance, if a business has a significant amount of account receivable, it must be reported separately in the balance sheet. That is the materiality concept. We also have what is called the consistency principle. This principle states that accounting method and procedures should be consistent from one period to another. For example, if a business is using FIFO, meaning first in, first out method to value their inventory, it must continue to use that same method in subsequent period. When there is a change, it must be recognized in the financial statements and it must be disclosed. This is the consistency principle. And lastly, we have the comparability principle. This principle states that financial statements should be presented in a way that allows for comparison with other businesses or other period. This is for us to be able to know if really the business is progressing. And you can only know this if there is a comparison with other businesses or other period. For example, if a business presents its financial statements in a particular format, it should continue to use the same format in subsequent period so that it can be comparable. These are the basic foundations of accounting. I want you to watch this video repeatedly to understand the concepts and drop your questions. In the next class, we will explore more advanced topic in accounting. Please watch this video and send your questions to my WhatsApp number on 08034162110. Our team will be available to assist you. Our goal is to simplify practical accounting to its simplest form so you can understand it. See you in the next class. Bye.